Alright, we have come to strategy number 2, value investing. Now, value investing, there's a few things that we need to look at, okay, which is known as a fundamental analysis. Basically, we look at the fundamental of the company, whether is it a good company, does it have a competitive edge, and whether or not they are being valued at a fair price. We can take a look at the financial statement to determine if the profit is increasing, is the cash flow increasing as well, and also does the company have a reasonable debt. We prefer not to have a company which has high debt. Just imagine a company that has low profit, low cash flow, but extremely high debt. Now, how sustainable do you think this company is? Which is likely not, right? So you need to have a company which has good profit, good cash flow, and preferably low or reasonable at least debt. Okay, next is what we call a moat. Now, what is a moat? So a moat is the water surrounding the castle. You know, ancient time, the castle are actually surrounded with water full of crocodiles that actually prevent people from anyhow going into the castle, and they only allow one an exit to and from the castle. Okay, this is what we call a moat. And when it comes to business, when we say a wide economic moat, it means, is it easy to enter into the industry, or is it easy for other competitors to take over the position of the company in the market itself? There's a few things can show how strong is the moat of a company. For example, you have branding, you have entry barrier, you have patented technology, you also have high switching costs. Now, these are just a few things that serve as a good moat. Okay, of course, there are many more. Now, branding. When I say fast food, which are the company that comes into your mind? McDonald's, Pizza Hut, Domino's Pizza. So these are the few company that has very strong branding, which act as their white moat. Is the carbonated drink that is the first thing that come into your mind? Coke, Pepsi, right? So these Coke and Pepsi also have branding, a good branding, as their wide economic moat. And barrier of entry. Now, not all industry are easy to enter. You can easily just open a restaurant as long as you have the capital, but it's not easy for you to enter into a semiconductor business and start manufacture chips, right? And you also have patented technology. Certain company patent their technology so that other competitors are not able to use the technology that they have. This can serve as a good moat to protect their company position so that other company cannot steal their technology. And also high switching costs. Let's say your company is already using Microsoft as most of the software to do your work. Do you think the company will easily switch to other software? Like right now, instead of using PowerPoint, let's all use Keynote from Apple. Instead of using Microsoft Words, let's all start to use Page from Apple, or maybe some other open source software. It's definitely not easy, right? Because Microsoft already well established and their support team has been growing very strongly. So all this we consider high switching costs. And also, like if you are using Apple ecosystem, from your phone to your MacBook and to iPad, everything, it's well integrated into one another. Would you think so easily about switching to something else which is totally different? Chances are unlikely, although I wouldn't say completely no. So this high switching cost is also act as the company's wide economic moat. Now, next is management. A good management team is able to drive sales of the company and it will increase consistently over a period of time. Okay, but the bad management will only drive their profit margin to become lower and lower. So it's very important to have a good management team to manage the company. And lastly, you need to determine the fair value of the company. Let's say you like a t-shirt a lot and the t-shirt is selling at $100, and you know that in 2-3 months time the same shirt will be selling at 20 to 30% discount. Would you rather buy now or wait for the shirt to have discount? Now chances are you wait for the shirt to have discount, right? Because it's the same shirt, but instead of paying $100, you just need to pay $80 or even $70 for the same shirt. Same goes to the stock price. You will never want to pay too much for the same stock. Not to say that this stock is not a good business, but you need to make sure that you are paying a fair value or a discounted value for the same thing. And that's where you can actually have this margin of safety in your investment. He is the greatest investor in all time, or at least in our time, and his name is none other than Warren Buffett. He is known for his value investing approach. And let's take a look at his quote. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And also, in the short run, market is a voting machine, but in the long run, it is a weighing machine. What does it mean? Basically, he believed that if, let's say, the stock A is a very decent stock, and right now it is selling at $100, and stock B is a not very good stock but selling at $10. Although this is selling at 100 and this is selling at 10, but stock A actually provide more value to us as an investor because this is a wonderful company that fulfill all these criteria, compared to stock B, although it's cheaper, but it has a lot of hit and miss in terms of all the analysis over here. And also, stock A right now, let's say it's selling at $100, but some bad news can actually pull the market down, and right now it is selling at $80. Because short-term market is irrational and it can be affected by news and investor sentiment. When people see that there's bad news, they are so afraid that they start selling their position as they think that the price will actually go down further. Hence, this for value investor might be a good time to enter because it is selling at a great discount below how much the company is actually worth. And of course, if you hold it for long term, it's a weighing machine because it will always reflect its true value, how much the company actually worth in the long run. This is the idea of fundamental analysis and also value investing. Now, I have talked about how to identify good fundamental business. And ideally, this company that you plan to invest is in the mega or large cap. If you recall, mega cap refers to a company that has more than $200 billion valuation, and large cap is more than 10 billion up to 200 billion. Now, this mega and large cap actually has some of the best company that you can invest in. We just stick to mega and large cap, okay? It's not really about calculating fair value, but instead I'll show you how to find fair value and intrinsic value of the stock price. Basically, these two means the same thing, alright? And once you identify how much is a stock worth based on the fair value, you can identify a few buying level. For value investing, very important to know that you should not buy the stock with all the money at one go. You should identify a few buying level and split the sum into maybe based on percentage or amount, and then you identify a few buying level so that when the price drop to this level, you can buy according to how much is your allocation. And ideally, we wait for the price to go below 15 to 20% below its fair value. Let's say the stock is worth $100. Right now, the market price is, let's say, $110. And due to some bad news, or maybe the earning is not so ideal, it missed the analyst estimation, the stock price start to fall. And when you fall to $100, are you going to buy or you are going to wait? There's nothing wrong with buying at $100 because it's at fair value, but in our approach, we prefer to buy with a margin of safety. Let's say the price we intend to buy when it dropped 20% as our first level, which is $80. So we just wait patiently for the price to drop at $80 before you can buy. Let's say you split into 3 portions, 30%, 30%, and 40%. So you can allocate your first 30%, and if the price go lower and you have previously identified your second level of purchase is at $70, which is selling at 30% discount, and your last allocation you have decided that it will be at $60 level, and this will be your full allocation. And indeed, if the price go down to $60, then you buy with your last 40%. After that, if it go further down or even lower, it doesn't matter, because what you have planned is to make it into 3 allocation, and based on this 3 buying level. It can still go down, but as long as you are buying or average in at the discounted level, basically you already have a decent margin of safety compared to how much the stock price is actually worth. And if you remember, Warren Buffett said that in the long run, stock is a weighing machine, because the stock will always go up in the long run as long as it's a good company, and it will go exceed or at least to the fair value, right? And that's how you actually generate profit from your investment. And of course, the idea for buying a good stock is to hold it for long term. Now, for Warren Buffett, he believed that the best period of time to hold the stock is forever. That's for him. But for us, of course, we are not going to hold forever. That's at least for me. So I will have a set of criteria on when I'm going to sell my position, which I will also be covering later on. Okay, for now, just take it as you are going to hold the good stock for long term, ideally 5 to 10 years. If you can, just hold it through retirement, as it will generate a lot more return for you in the future. I'll break down into steps for fundamental analysis. Now, step 1, we identify the company that you like, and especially they are known to be market leader. Remember the exercise earlier that when I say certain industry, there's a few company come into your mind. You can actually also, based on this, to decide what company you want to invest. Otherwise, you can go to finviz.com. Under this map, you can copy this link to see what are the company available. Let me show you. Now, this is finviz.com. If you go to finviz.com, you go over to this map. Okay, just click on it, you'll come to this page. Remember, there's 11 sectors. All these sectors are actually listed over here. Real estate, energy, consumer cyclical, financial, utilities, basic materials, industrial. And within this sector, you have a lot of subsector as well. So in software, you have Microsoft, consumer electric, you have Apple. Semiconductor, you have Nvidia, and also yeah, software application, you also have your ServiceNow, you have your Salesforce. Communication, you have Google, Meta. Consumer cyclical, you have Amazon, you have Tesla, and you just look at the size of the square. Now this size of the square shows that how much weightage it is in the S&P 500, because this whole map is based on S&P 500. You can hover, it will show you the name of the company, right? You can see this is Alphabet, Nvidia Corporation, CRM is Salesforce, so on and so forth. So from here, you can identify which are the few company. If you just want to look at the mega cap, you can go to Screener. Under market cap, select mega cap. It will automatically filter the companies under this mega cap for you. And there's total about 42 company in the mega cap. So from here, you can slowly do your analysis to decide which are the company that you intend to buy and hold long term. Of course, you can go to large cap, but large cap has a lot more company. You have 39 pages. So have fun exploring this website. It's completely free, and hopefully you can find something good out of it. Step 2 is determine if the company is profitable, is the profit is increasing, is the cash flow is increasing, and in this case we are referring to the free cash flow, and also if the company have low or conservative debt. Now for that, personally, I don't really look at it, because some industry naturally they just have a high debt, and I know that I only invest in some of the great company in especially the mega cap or even the large cap, which have their very good economic mode. I can just neglect this a little. So personally, I don't really look at that, but I'll just make sure the profit is increasing and the cash flow is increasing as well. After some times doing this fundamental analysis, you will also know certain company, their profit has been increasing consistently and as well as cash flow. So although they just miss one or two statement, it's not so much of a big deal as long as the fundamental is the same, the business model is the same, and they have good economic mode. Okay, so these are the few websites that you can use to refer, but for now I'll only refer to Yahoo Finance because this is a free version and these two are a paid version. Personally, I also subscribe to Morningstar, which I'm a paid subscriber, so I will use this to take a look at some of the statement and also the intrinsic value. But for you guys, if you are not prepared to pay, you can just use the free tools over here and also some other website that you can find. For Yahoo Finance, you just search based on ticker symbol or the company name. You'll see all these company prompt up. You just click on the one that you want to choose. And if you take a look at financial, you can see that they actually have income statement, balance sheet, cash flow, and most of the time I'll just stick to annual. And for income statement, you just take a look at revenue. Is it increasing every year? Increasing. This is increasing, and this is also increasing. And also the net income has been increasing as well. You can go to cash flow. Take a look at their free cash flow right at the bottom. Is it increasing? Yes, so for the past few years, it has been increasing. So we think that this company is actually a good company and worth investing. Now, of course, this is Apple. We all know that it's a good company. For company that you are not too sure, but it's in the mega cap or large cap, this is how you can see if the company is actually making a good progress. Usually, I will only invest in company that I know what they are doing. So if you talk about name like McDonald's, Microsoft, Amazon, Google, for all these stocks, I do not look at their financial statement because I really know or I trust that the company is actually doing very well. If you were to manually calculate the intrinsic value of the company, you will have to go through this statement to pick some of this amount. But the method that I'm going to show you, you don't actually have to do the calculation yourself because there's a few websites that you can refer to. So if you want to skip this step, and if you truly believe that skipping this step is totally fine as you trust the company a lot, I leave it to you, and I will just show you how to look at, more importantly, the intrinsic value of the company. Determine the intrinsic value of the company is, I see this as the most important step in the fundamental analysis. I would usually skip step 1. I will usually skip step 2 as well, because I already know which are the company that has been generating profit over the years, and I will just focus straight to step 3. Now, step 3 is to determine the intrinsic value or the fair value of the company. There's a few websites that you can refer to. Valueinvesting.io is, so far I've been using it for free, and if you like their service, you can choose to subscribe to the paid version. It's slightly cheaper than Morningstar. So for Simply Wall Street, I've been using the free version. Morningstar, I've been using the paid version. Okay, so I will show you this tree. Let's go through it now. Valueinvesting.io. Now for valueinvesting.io, free version, you can view up to 5 stocks. So choose your stock wisely, because whichever stock that you first key into the this search bar, it will be logged into your stock view, and you only have 5 stocks that you can view. So I already have my Apple over here. Okay, under this discounted cash flow, you just have to take a look at here. It says fair price. Basically, it means fair value. So this is the fair value of how much Apple is worth. And right now, Apple is trading at $191.81. Is definitely overvalued as compared to the fair value. Another website is Simply Wall Street. Now, Simply Wall Street, you just need to search the company that you want to search. Under the valuation, of course, here there's some performance, research, or analysis that you can refer to if you're interested, but I will just go straight to fair value. Here, 1.6, share price versus fair value. If you take a look at the fair value, currently is based on this website is at $130. Now you notice that different website, they will have different valuation for the same stock. That is because the amount of projected growth that they use is different when they're doing their measurement, and different analysts have different sentiment about the company, about how far the company can grow and how fast or how well the company is going to grow in the future. Some are more conservative and some are more aggressive in their calculation. So for this, obviously, it's more conservative. They only evaluate the company at $130, and compared to current price, it's about 46.7% overvalue. So if you use the valuation and you think that you want to buy at 20% below this fair value, there's a good chance for company like Apple, not guaranteed, that it may or may not go below this fair valuation and to the buying level that you identify. How I use to evaluate is I use multiple website, their fair value amount, and I add up together and divide accordingly and get an average. So I'll use that instead as my fair valuation to the company. For Morningstar, let me remove this. For Morningstar, you can take a look. Okay, this is Morningstar website. Of course, these are all shown when you are paid. Otherwise, you won't be able to see this. Morningstar give Apple a fair value of $150. Okay, which is right in the middle of this valueinvesting.io and also Simply Wall Street. You can use these three value to calculate. Example, this one is a 164.8. Let's take it as 165. You can add 150. You can add 130.77. Oops. Say 130. You add all these three together. Let's see how much is it. 165 plus 150 plus 130 equals to 445 divided by 3, and you get roughly about 148. Very close to Morningstar, and that's why I always use Morningstar as a reference, and I prefer their evaluation of the company. Assume you don't have Morningstar, you just calculate based on 165 plus 130 and you divide by 2, you come to 147.5, which is actually pretty close as well. Okay, so that's how you can use the simplest way to check the fair value of the company without doing all the calculation yourself. Let's just say you already identify the intrinsic value of the company. The more important question is when to buy. Now you can wait for the price to drop ideally 15 to 20% below the fair value before you start buying. Okay, there's a few pointers to take note. First, you have to find the support or the buy level of the stock that you want based on percentage value. Like how far the price drop, then you buy your first allocation, your second allocation, your third allocation, or maybe your fourth allocation if you intend to do 4. Or you can use technical analysis, which I will go through later. It will be a very basic technical analysis. And also remember to allocate your fund based on a few buying level instead of buy all together in one lump sum. Let's say this Apple stock is worth about $150. And I have $10,000 that I want to invest in Apple. I can split into 3 or maybe 4. If let's say I split into 3, what will I do? I will put 30% in my first allocation. My second allocation, I will put maybe 40% because I think that Apple unlikely to go too low. So my second allocation, I input a higher weightage, and my third allocation, I put my remaining 30%. At fair value, I have $150. If I wait for Apple to drop 20% below fair value, which will be about $120. So I will identify my first buy point at $120, and if it drops further, it go to maybe 110, I will allocate my next 40%, and if it's dropped further to maybe $100 level, I will allocate my last 30%. This price point or buy level, you can identify by percentage of the price that they retrace. So what do I mean? You know that this stock is worth about $150. 20% below valuation is $120, which this is what I already plot over here. But of course, these two figure is not based on the percentage. If I want to be based on percentage, I want to buy when it drop to 30%, which is 105. And only when it go to 105, I will add in another 40%. And if I want to buy my last at 40% discount, which is $90, and this will be my final addition. This assume it would drop 20%, this assume it drop 30%, and this assume it drop 40%. Okay, this is how I will allocate. If you intend to do 4 portion, you can always do like 25%, 25%, 25%, 25% of your 10K capital. Based on the same rules, say $150, and the first one you want to drop 15%. Okay, now we can play with a slimmer margin. For $150, if Apple drop 15%, it will be $127. So I will buy at $127. And the second one, I want to buy at maybe 20%. Now we already know this price. At 20% discount is at $120. Then only I do my 30% and 40%, which is earlier already show 105 and also $90. Now you can also use this way to plan your investment entry. There's no one fixed way, it's all up to you. Which method do you prefer to use? Or if you want to change the allocation or change how much the price drop before you make your purchase, you can do so as well. Now this is a simpler method that you can just determine based on a few percentage without looking at the chart or anything else. All you need is just to know the fair value and also how much the price has to drop before you add in your position. Technical analysis is a little bit more advanced because you need to learn a bit about charting. For technical analysis, which I will go through later on, I will show you how to identify support and resistance level based on horizontal line and also moving average. Horizontal line, I'll teach you how to draw on the chart. If the price fall down, go up, fall down and go up, drop and then go up and form a range, this will be your support line and this will be your resistance line. Okay, so I will teach you how to draw the support and resistance. As for moving average, a simple moving average, basically this one you just need to input a study into the system, into the charting platform, and it will automatically come up with all the moving average lines that shows you where are all these 20 and 30 and 50 days, 100 days, 150 and 200 days lines are formed. Okay, sometimes this moving average serve as a support as well. Depending on the nature of the chart of that stock, you might not always be able to use moving average to get what you want, and sometimes you have to use horizontal line. And sometimes if the chart is very beautiful, it going up on a 45-degree angle, likely you are able to use this moving average to determine which is your support level.